Welcome to Finance Podcast, where we guide you to financial freedom.
Okay, so we're diving into the world of investing, and wow, have we got some heavy hitters in our corner for this deep dive. We're talking Kiyosaki, Graham, Buffett.
Yeah.
It's like the all-star team of investing advice.
You're not wrong. And you know what's fascinating to me? Even with their own unique styles and approaches, there's this surprising amount of overlap in their core investing philosophies.
Yeah, it's like they're all playing the same game, just with like different strategies or playbooks, you know?
Exactly. And the first level of this game, like even before we think about picking stocks or bonds or whatever, seems to be all about mindset.
Totally. They all talk about how you think about money, your relationship with money being just as important as like the technical stuff, the actual mechanics of investing.
Absolutely. And several of them really zero in on this thing that Kiyosaki calls financial education.
Right. Which isn't just the typical how to balance a checkbook kind of thing, right?
No, not at all. Kiyosaki argues that, honestly, traditional education often misses the mark when it comes to building wealth.
It's like that whole rich dad, poor dad philosophy he's so famous for.
Exactly. That contrast between his own father, the poor dad, who followed a more traditional path, and his friend's father, the rich dad, who approached money completely differently.
Right, the rich dad
Yeah.
who saw opportunities where others saw obstacles and knew how to like make money work for him, not the other way around.
Exactly. And Kiyosaki is all about understanding things like income types earned versus passive income and really getting a handle on financial statements.
So it's not just about earning a lot, it's about understanding how that money's flowing
Yeah.
and how to potentially create like multiple streams of income, right?
Exactly.
I remember him even using a shower head once to explain assets to his partner, Kim.
Haha, yes. That's a classic Kiyosaki story.
It really highlights that you can look at even seemingly mundane things through this lens of assets and liabilities.
Right. It's a whole different way of thinking about your resources. And more importantly, it shows how crucial it is to be proactive about your financial education, even if it means challenging conventional wisdom.
And this whole mindset shift, it's not just about understanding like financial jargon or whatever. It's also about emotional discipline, which, let's be honest, can be tough when you're dealing with your hard-earned cash.
Oh, it's incredibly important. And that's something Graham and Buffett especially, they really echo that sentiment. They emphasize that being a successful investor isn't necessarily about being like a genius or anything.
You don't have to be a math whiz.
No, it's more about having that solid logical foundation and not letting emotions drive your decisions.
So no making decisions based on like fear or
Yeah.
greed or those get-rich-quick daydreams.
Exactly. Buffett has this great analogy about valuing a racehorse. He says, you wouldn't just bet on a horse because of the odds, right?
You want to like see it run, know its history.
Exactly. You'd want to understand its lineage, its track record, its overall health. You'd look at the horse's intrinsic value before even thinking about the bet.
That's such a good point. It's like cut through the hype, the noise, and really understand what you're putting your money into.
Exactly. And speaking of cutting through the hype, Peter Lynch, who has a very different investing style than Buffett, by the way, he also talks about the importance of tuning out the noise and not getting intimidated by those inevitable market swings.
He's all about the long game, right? Having the patience to ride out those ups and downs.
Absolutely. And you know what? He loses it too. Remember that story about how he decided to buy Volvo stock?
Oh yeah, classic Lynch. He buys the car, loves it, and then looks at the company. Talk about believing in your own experience.
Exactly. And that's a key part of this mindset shift we're talking about. Trusting your judgment, doing your research, and not letting the market's short-term craziness dictate your decisions.
So it's about becoming like an informed and empowered investor, not just blindly following the crowd or like panicking when the market dips.
You got it. And that brings us to another crucial aspect of this mindset shift, tuning out the noise. And this is where Dave Ramsey's insights are so valuable.
Because he's like the anti-financial news guru, right? He's always saying, ignore the hype, ignore those doom and gloom predictions.
Exactly. He argues that constantly listening to financial news can actually make you more anxious and lead to emotional decisions, which, as we've discussed, can be detrimental to your long-term investing success.
It's like trying to think straight in a crowded, noisy room. Sometimes you just need to find that quiet space to make a clear-headed decision.
Precisely. So to sum up this first crucial lesson from these titans of investing, it's about cultivating the right mindset, Prioritize financial education, think long-term, tune out the noise, and don't let your emotions control your investment choices.
Okay, so we've tossed out those get-rich-quick fantasies. We're in it for the long haul, and we're like wearing noise-canceling headphones when it comes to the financial news cycle.
Love the visual.
But how do we actually translate all of that into picking winning investments? Like, what are the plays these titans of investing are actually using to build their portfolios?
That's the million-dollar question, right? And it's interesting because while each of these experts definitely has their own unique approach, there is this common thread of respecting the long game.
Not trying to time the market or chase the latest trend.
Exactly. It's about making informed decisions based on solid research and analysis, not just trying to make a quick buck.
And understanding that risk is just part of the equation.
Absolutely. There's no such thing as a risk-free investment, right? It's more about understanding the risks involved and making sure they align with your own personal risk tolerance.
Right. So no guaranteed win scenarios. Got it.
Exactly. And this whole long-term perspective is something that both Carl Icahn and Charlie Munger emphasize, even though they have very different investing styles.
Which is interesting because Icahn, he's known as the quintessential activist investor, right? The guy who comes in, shakes things up, pushes for change. Doesn't sound very long game.
I know, right? He's got that reputation. But when you look at his actual track record, it challenges that stereotype a bit. I mean, did you know he's held companies like ACF Industries for over 3 decades?
Wow. 30 years, that's serious commitment.
Right, and that's just one example. He's held numerous companies for decades, which suggests that his strategy isn't just about short-term gains.
It's more like, I'm here to make a difference and I'm in it for the long haul.
Exactly. And then you have Munger, who takes a different but equally insightful approach to this whole long game idea. He's famous for this analogy of Mr. Market.
Oh yeah, I've heard of this.
So imagine a guy, we'll call him Mr. Market, and he shows up at your door every single day, offering to buy or sell you stocks at various prices.
Okay. Sounds kind of pushy.
Right. And here's the thing. Some days his prices are reasonable, but other days they're completely bonkers, totally out of whack with reality.
So Mr. Market, he's a bit unpredictable. Maybe a little emotionally unstable.
Exactly. And Munger's point is that the market, just like our friend Mr. Market, can be driven by emotion and irrationality, especially in the short term. But, and this is the important part, you don't have to play his game. You don't have to buy or sell based on his whims.
You can just be like, sorry, Mr. Market, not today.
Exactly. You're in control. You can wait for those opportunities that actually align with your goals and your assessment of a company's true worth.
So it's about having that discipline to say no to those tempting but potentially risky trades and wait for the right pitch.
Exactly. And that actually leads us perfectly into another key principle that both Graham and Buffett emphasize, the margin of safety.
Which is about building in a buffer zone, right?
Yeah.
Not cutting things too close.
Yes. Think about it like buying a used car. You wouldn't just pay the sticker price without factoring in potential repair costs or anything, right? You want some wiggle room just in case things don't go exactly as planned.
On that just-in-case fund.
Exactly. And in investing, that just-in-case fund comes from buying a company for less than you think it's actually worth. Graham and Buffett talk about aiming to buy $1 for 60 cents, which gives you that built-in margin of safety.
Okay, so we're thinking long-term, we're managing risk, we're looking for that margin of safety. It's all starting to come together. But how do we go from these broad principles to actually choosing investments? Do our experts give us any guidance on that?
They do, and this is where their individual styles really start to shine through. Take Dave Ramsey, for example. He's all about simplicity and diversification. He suggests building a portfolio around 4 basic types of mutual funds: growth and income, growth, aggressive growth, and international.
So diversifying across different types of funds helps to spread the risk.
Exactly. It's like that old saying, don't put all your eggs in one basket.
Makes sense.
And Ramsey really stresses choosing funds with a solid track record. He wants to see consistent performance over time, ideally outperforming the S&P 500.
Which is basically a benchmark for how the overall market is doing, right?
Exactly. So it's like you want your investments to at least be keeping up with the market average, but ideally you want them to be doing even better.
So aim to beat the average.
Right.
Got it. What about Peter Lynch?
So Lynch, he definitely takes a different approach, and he's really big on understanding those different categories of stocks.
Oh yeah, he's got those 6 categories he always talks about. Fast growers, slow growers, cyclicals, turnarounds, asset plays, and stalwarts. It's like he's saying there are different games within the game.
Exactly. And you need to understand which game you're playing to be successful. Like, you wouldn't approach a brand new tech startup the same way you'd approach a well-established utility company, right?
Right. Totally different ballgame.
And Lynch, like all our experts today, really emphasizes the importance of truly understanding the businesses behind those stocks.
It's not just about like looking at charts and graphs. It's about what does this company actually do?
Right, exactly. It's about how do they make money? What are their competitive advantages? What's their long-term growth potential?
It's like looking beyond the stock ticker and seeing the actual business behind it.
Precisely. It reminds me of that story about how Lynch decided to invest in Chrysler.
Oh yeah, he saw how well those minivans were selling.
Yes, it all started with an everyday observation. He saw the minivans were selling like hotcakes, did his research, and realized the company might be poised for a turnaround.
It's like he found a hidden gem that the rest of the market was overlooking.
Exactly. And that's what Lynch is all about, finding those companies that have the potential for significant growth, even if the market hasn't fully recognized it yet. So we've gone from broad mindset shifts to the importance of long-term thinking, managing risk, and now we're starting to see how these experts translate those principles into concrete investment strategies.
It's getting really interesting, but it also seems like this is where things get really personal, right? It feels like we've gone through like a crash course in investing wisdom here. We've talked about everything from broad mindset shifts to very specific strategies. But if I had to sum it up, it seems like the big takeaway is that there's no magic formula, right? There's no one-size-fits-all approach to investing.
You're absolutely right. It's about taking these incredible insights from these investing giants, these titans, and figuring out what works best for you, your own goals, your own risk tolerance, your own individual circumstances.
It's like they're giving us the tools and it's up to us to build something amazing. Right?
Exactly. It's about becoming an independent, informed investor, somebody who can make those smart decisions based on their own research and understanding.
Which, honestly, can feel a little intimidating. Like, having to trust your own judgment when it comes to something as important as investing.
I get it. But that's something that both Lynch and Buffett emphasize. One of the best ways to build that confidence is to really, truly understand the businesses you're investing in. Remember Buffett's thought experiment about, like, imagine you had to invest your entire life savings in a single business.
Oh yeah, and you couldn't sell it for 20 years.
Exactly. Talk about pressure.
I'd definitely be doing my homework in that scenario.
Right. You would approach that decision with the utmost seriousness. You'd want to understand every single aspect of that business, their products, their customers, their management team, their competition, everything.
Suddenly those quarterly reports and earnings calls don't seem so boring anymore.
Exactly. And that's exactly Buffett's point. It's not just about crunching numbers. It's about understanding the company's story, their long-term potential, their ability to adapt, to weather those inevitable storms.
It's about looking beyond the stock ticker and seeing the actual business behind it.
Exactly. And Peter Lynch, he echoes that sentiment. He's all about making research an engaging process of uncovering those stories.
He's the king of finding those hidden gems, those under-the-radar companies, like that story he tells about the fireman who became a millionaire by investing in the local factory that was always hiring.
Exactly. Lynch wants you to be curious, to really look around your own world and ask those questions. What are people buying? What can't they live without? He even has that rule about, like, could you explain the company to a fifth grader in just 2 paragraphs?
I love that rule. It really forces you to cut through the jargon and get to the heart of what a company's all about.
Right. If you can't explain it simply, you probably don't understand it well enough to be putting your money behind it.
So true. And it actually reminds me of another big advocate for simplicity. John Bogle, the pioneer of index funds.
Yeah.
He had that whole hedgehog approach, right?
Yes. He argued that for many investors, it's better to be a hedgehog, focused on one simple, effective strategy than be like a fox, chasing after all these complex ideas. And his simple, low-cost index funds, they actually have this incredible track record of outperforming those fancier, actively managed funds over the long run.
It's like that saying, slow and steady wins the race.
Exactly. Tune out the noise, focus on the fundamentals, and let the market's overall growth work its magic.
So, wow, we've covered so much ground in this deep dive. But if we had to leave our listeners with just one key takeaway from these investing legends, what would it be?
I think the most important thing to remember is that successful investing, it's a journey, not a destination. It's about cultivating that right mindset, understanding your own unique goals, and honestly, just enjoying the process of learning and growing as an investor.
Becoming the captain of your own financial ship.
Exactly. And remember, you don't have to be some kind of Wall Street whiz to succeed. These titans of investing, they've given us the tools, they've given us the frameworks, and now it's up to us to go out there and use them.
And on that note, here's a final thought for you to ponder on your investing journey. What if, instead of just focusing on those returns, you also consider the impact of your investments?
Ooh, I like that.
Could you align your financial goals with your values and invest in companies that are actually tackling those big challenges facing the world?
That's a powerful question. It's something more and more investors are asking themselves these days. It's like that idea of, can we do well by doing good?
Exactly. Maybe it's about building a brighter future, one investment at a time. Well, that's all the time we have for today. Thanks for joining us on this deep dive.
Thanks for having me. This was fun.
We hope you've gained some valuable insights to help empower your investing journey.